Today, we're taking on the ultimate financial gauntlet. Every single day, thousands, literally thousands of stocks change hands on the open market. The sheer volume is just staggering. And here's the reality. Some of these companies, they're going to turn into massive wealth generators, handing incredible compounding returns to their shareholders. But others, they'll just tread water, kind of stagnating year after year. And honestly, a pretty massive chunk of them will just completely crater. So the literal million-dollar question we're answering today is, how do you actually separate the noise from the gold? Which brings us right to our core question. How do you actually find profitable companies? Now look, you don't need to rely on complex Wall Street algorithms, esoteric data points, or chaotic trading models to figure this out. No way. Instead, we're going to lean on a really sharp, straightforward framework that cuts right through all that noise. We're going to break down the highly practical, completely understandable mechanics that smart investors use to spot elite businesses. Okay, let's dive into this by tackling the biggest misconception right out of the gate. A profitable company is not just a company with a rising stock price. I know, shocking, right? But stock prices are constantly driven by hype, excitement, and, let's be honest, social media momentum. Amateurs, they chase those fast-moving lines on a chart. Smart investors, though, they act like business owners. They don't just stare at price action. They look under the hood to answer one absolutely vital question. Is this company financially strong and structurally built to grow over time? So here's our roadmap. We'll start with the financial fundamentals. Then we'll look inside the business machine, shift gears into the investor mindset, and finally, bring it all together into your investing blueprint. All right, part one, the financial fundamentals. We're talking real growth and profit here. So the very first true metric of quality is consistent revenue growth. And notice I said consistent. We are not looking for a one-off spike from a lucky quarter or some temporary surge because a product went viral. We want a clear, sustained upward trajectory. Because if revenue is compounding year over year, it usually means the company is successfully capturing more market share and driving real organic demand. Basically, more customers are actively paying for what they make. And that's sustainable growth. That matters way more than short-term noise. Now, what's really interesting about this next point is that revenue alone just isn't enough to declare a company a winner. We see this all the time, right? Flashy startups with massive revenue, but they're bleeding cash at a terrifying rate. The ideal scenario is actually consistent profits paired with healthy margins. A company that generates real earnings just has a much stronger, more resilient business model. You want businesses that don't just push products out the door, but actually retain cash, expand their earnings, and maintain strong margins. At the end of the day, profits are the true fuel for long-term compounding. Moving on to part two, inside the business machine. Let's look at how it actually works. Once the numbers check out, you've got to look under the hood and ask a brutally simple question. How does this company actually make money? Seriously, if you can't explain a business model simply to a friend over a cup of coffee, you have absolutely no business investing your hard-earned capital in it. It's that simple. Great investors love simple businesses because, well, they're predictable. A clean, easily understood operation is vastly easier to evaluate and keep tabs on over the long haul. Next up, you need to identify their competitive advantage. Think of this as the economic moat around the castle. Why do customers actively choose this company instead of just walking across the street to a rival? Companies with deep, enduring economic moats protect their profits for decades, mainly because competitors find it nearly impossible to replicate their success or steal their market share. So what exactly digs that moat? It usually boils down to a few distinct, undeniable edges. Maybe it's impenetrable brand power, where people just inherently trust the name. Or a genuinely, objectively superior product. What about an intensely loyal customer base? Or perhaps it's proprietary, patent-locked technology, or an unmatched low-cost production model that rivals literally can't touch. When a company holds these cards, they kind of hold the whole market. Then comes the critical reality check, debt. Now look, corporate debt is fine as a strategic growth tool. Everybody uses it. But excessive leverage, that is a ticking time bomb during an economic downturn. When liquidity dries up and things get tough, over-leveraged companies get wiped out entirely. You want to align yourself with businesses that boast fortress-like balance sheets and manage their capital responsibly. That ensures they can weather pretty much any macroeconomic storm. You also have to relentlessly evaluate the human element here, the leadership. A company is entirely at the mercy of the team running it. So, run through this mental checklist. Is their vision clear? Are they growing sustainably, or just throwing cash at the wall to see what sticks? Are they making smart, deliberate, long-term decisions? Expert capital allocation for management can navigate a brutal economy, while reckless, ego-driven leadership can sink an unsinkable ship. Finally, for this section, look at the macroeconomic wind. Is this company sailing into a fierce headwind, or are they being propelled by massive, generational shifts? Think things like artificial intelligence, clean energy, or advanced biotech. Operating in an industry with an expanding total addressable market provides a massive structural tailwind for growth. But remember, and this is absolutely crucial, the underlying business must be fundamentally sound. Never ever deploy capital just because a macro trend is suddenly trendy. All right, part 3, the investor mindset. This is all about thinking long-term. Here is where the math stops and the psychology begins. You have to ruthlessly avoid emotional investing. Buying a stock just because some Reddit thread is hyping it up, or because you've got severe FOMO during a massive rally, that is a guaranteed recipe for disaster. Chasing the next big thing based on social media chatter is wildly dangerous. True wealth generation requires deep, objective analysis, not a hit of adrenaline. So the crucial point is that the ultimate antidote to all that hype is consistency. The strongest, most resilient companies are almost boring in their stability. They deliver consistent revenue growth, consistent earnings, and consistent performance year after year, decade after decade. In the world of long-term wealth building, boring is actually beautiful. It's the bedrock foundation that lasting financial independence is built on. And doing this requires a complete paradigm shift. We've really got to stop asking, hey, will this stock go up next week? That's a short-term trader's game. Ask instead, will this business be significantly larger and more profitable in 5 to 10 years? A strong company today should have the mechanics in place to be dominant a decade from now. Adopting that single lens, it changes absolutely everything about how you deploy your capital. Which brings us to our final section, Part 4, Your Investing Blueprint, the complete framework. And this brilliantly illustrates your ultimate blueprint. Bring this framework to every single potential investment. Demand consistent revenue and real expanding profits. Ensure you completely understand the business model and just how deep their economic moat really is. Verify they have a fortress balance sheet with manageable debt. Bet on top-tier leadership in growing industries. Actively ignore the social media hype, and always prioritize consistency. If a company checks all these boxes, you've found yourself a fundamentally sound winner. I want to leave you with a really powerful thought to anchor this entire strategy. Successful investing is not about chasing excitement. It's about recognizing quality. Finding exceptional companies isn't about stumbling onto a lucky ticker symbol or timing the market perfectly. It's about intense observation, unwavering patience, and recognizing the strong mechanics of an elite business. So as you take this blueprint out into the open market, let this one lingering question dictate every single move you make. Are you just renting a piece of paper, or are you truly thinking like an owner? Master that perspective, and I promise you, you'll never look at the market the same way again.